let's push off here and get going. We're going to have four parts to the presentation today. We'll do a brief review of the market strategy that we were rolling out a year ago and go over the four key themes for 2025 and talk about how we did with predicting what we needed to be concerned about. Then we'll do a market recap. The headline there is "Let's Get Out the Globe," because there were a lot of things going on around the world, and I'll preview that just briefly by saying that even though the U.S. stock market did terrific in 2025, the best returns tended to come from outside the U.S. Next, we'll do a market outlook. We'll talk about the future. It's going to get just a little bit technical today, feel a little bit like an econ class. The headline is "Revaluing Debt and Currencies." So should be a lot of fun for those of you that are more technical. And then we'll wind up with market strategy and four key themes for 2026. And we'll tell you what we think you need to be paying attention to for the next 12 months. So, all right, let's just jump into this. The four key themes for 2025. The first was brace for a tech crypto crash. Made Bill Harris a little bit nervous when I used the word crash, but the idea was that a lot of crypto exposure is leveraged. A lot of tech stock exposure is leveraged. And a crack in one of those could lead to a crack in the other. And when you're owning something with leverage, as many people found out during the housing crisis a while back, that can be a real problem. So let's look at how that worked out. At the end of the first quarter, it looked like I was going to be right, and honestly was not excited that I was, but a lot of tech stocks really got hurt in the first quarter. Now, these are the top 10 stocks in the U.S. stock market. You see Berkshire Hathaway there at the bottom, which did great in the first quarter. When all the tech stocks were going down, Berkshire tends to move in a bit of an opposite direction from a lot of those tech stocks. But then an amazing thing happened. We turned the corner at the end of the quarter, and going into the rest of the year, things went almost straight up for some of these stocks, it would seem. And so what we show you there in the last column is the total year return for those same top 10 stocks. So all the tech stocks got better. Some, like Alphabet, that was down 18%, ended up more than 65%. So what an amazing 3 quarters. Berkshire Hathaway didn't end up doing as well. So after a great first quarter, came back down over the remaining 3. But we didn't really end up with a crash by the time the year was over, because the rally back from that dip was just so strong. So some pretty amazing numbers to see there, and certainly shocked a lot of people. If we look at crypto, boy, what a roller coaster that was. Crypto generally went up throughout the year until the last couple of months. You may know that it's been down pretty hard so far in 2026, but we're getting some pretty big upticks, including today as we're recording this. So what I've listed there on the top row is just one of many ETFs that invests in Bitcoin as one of many cryptos that are out there in the today. So the 2025 return was negative 10.84%. That's generally reflective of what Bitcoin did, although crypto trades 24 hours a day, 7 days a week, 365 days a year. So when you want to look up what was the 2025 return, you have to pick your time zone to get specific about it, because you'll get different answers based on whether your new year starts in Paris or starts in New York or starts in California. So interesting little kind of data tidbit for you there. I have a column called the forward price earnings ratio, and that term for infinity is not technically correct. It's really a divide by zero error, because crypto has no earnings, just the same way gold and silver have no earnings. So not really infinity. When we look at BITO, which again is generally representative of Bitcoin, we see a almost negative 11% return. Now, I've got 2 other rows there, and it was just an opportunity for me to explain the dangers of leverage and how it can be applied. And the BITU, the next row down, is an ultra Bitcoin or 2x Bitcoin investment. And if you look at any particular day, Whatever BITU did twice, up or down, doesn't matter the direction, it did twice as much. That's in a day. So kind of interesting that for the full year, it was down more than three times what Bitcoin was down. That is a mathematical, I don't want to say anomaly, little weirdness if you're not used to it. That's known as the constant leverage trap, a well-documented thing. It's no failure on the part of ProShares to do exactly what they promised they would do. Again, you can look up the performance on any given day and see it'll give you exactly two times what it did. There's another version of that, the ultra short Bitcoin. It does two times in the opposite direction for whatever Bitcoin did. So on any given day, if Bitcoin's up 5, it'll be down 10. If Bitcoin's down 5, it'll be up 10. So you can make a bet in the opposite direction. So you would think with Bitcoin being down for the year about 11, it might be up about 22. That's what it would have done if you had that return for a single day. But because of this constant leverage trap that works out both the ultra up and the ultra short, we're in pretty negative territory for the year. And this is going to be a recurring theme throughout this presentation, the dangers of leverage and some of the surprises that investors can get. So we will tell anybody, if you're doing any trading on your own, shy away from these types of investments. Definitely don't let the market close still holding one of those positions. The next key theme was it's time to diversify. The public stock market is over-concentrated. Those top 10 stocks were about a third of the value of the stock market at the beginning of the year and a little bit more by the end. What we really mean with it's time to diversify is take a look at private markets. And we spent a lot of time in other presentations talking about private markets. Many of you know private credit is perhaps my favorite asset class. And the way we invest in private credit, we have a ton of confidence that'll be able to ride out an awful lot of the economic stresses that get theorized out there in a volatile year like this that we're in. There is a lot being written in the financial press about private credit, but we think that really is applying to the types of investments that we have no interest in and have not put client money into, not the safer end of the spectrum where we invest. So we think investing in private markets is a great way to diversify, but also private equity is a great way to diversify. And some people just think of that as having a lot of risk, but let me show you a chart here about the returns of private equity versus public equity. And over longer periods of time, we're getting returns out of private equity that are perhaps 4% higher on average per year than public equity. Our longtime investors certainly have seen that and maybe seen that gap be much higher. But in any given year, they just don't behave in the same way. Some years, public equities will give you the best return. Some years, like 2022, the gap that private equity offered over public equity, if you just look at these indexes, was phenomenal. But for the last 3 years, public equity has tended to do better. We're generalizing here, of course, with all of this, but that also creates an entry point. Even when both asset classes are going up, when one does better than another, that suggests take some profits from the one that did the best and put it into the one that didn't keep up quite as well. So while we think both of these asset classes are great long-term performers, having both gives you a neat little mathematical opportunity since they don't go up and down at the same time. Having both in there, again, we think both will be productive in the long run, means that you have a smoother ride than if you just had either one. So that's a great thing to be able to do. In fact, that means it lowers the risk in all likelihood when you're dosing in some diversified private equity to some diversified public equity holdings. And so that's a great thing. In fact, there's a lot of research out there to support that. You can go search for that yourself. This next slide here shows you how several firms put some research together. Wilshire, in particular, was behind this analysis and said, look, you actually lower your risk. They're trying to demonstrate by adding in some private equity. So for the same level of risk, just 20% of your equities in private equity historically has offered you about a 2% advantage in return. Again, for the same measured standard deviation. So just 20% in private equity for the same level of risk gives you about a 2% advantage that if you compound the extra advantage. It might be way more than you make. You compound 8% for a decade versus 10% for a decade, and you'll see a phenomenal difference in return. You end up with a lot more at the end, more than 50% more at the end if you take a minute to do that math. One more point to make about how you can diversify away from that exposure into just large cap U.S. stocks. Again, with private markets, is that it's easier to do than it's ever been before. So, longtime investors in private equity and venture capital are used to the traditional methodologies. You invest in one specific company, or you invest in what we call a drawdown fund. You experience capital calls for 5 years, and perhaps another decade later, you've had your money returned. So that can be a little hard for some people to plan for in terms of cash flow and when's the money in and when's the money out, because you really don't know those things at the beginning. But there's this new breed of vehicle called evergreen funds, and there's BDCs. You probably heard of that. There's interval funds. You may not have heard of that. But all of these are becoming more popular, and the great advantage there is you can put money in when you want to put money in. You're not just signing up for 5 years of capital calls, and down the road you can request liquidity. And so when we think of ourselves as financial planners around here, and we're trying to change the amount of exposure you have to each asset class, it's awfully nice to be able to put money in when we want, to pull money out when we want. I know that in the past, in working with clients, it sometimes took a full decade to build up a private equity portfolio, and could take even longer to shrink it back down if there was a need to make a change. So these new evergreen vehicles are very much a game changer for us, a game changer for you. And the newest evolution of those even has little to no paperwork. And so for those of you that have signed a dozen DocuSigns in the past year, that probably sounds pretty attractive as well. So the third key theme was that financial planning is critical. And I just know from looking at the numbers that a lot of our clients got the financial plans updated in 2025, which is terrific to see, because there's often risks out there we can mitigate. And then the last key theme was that safer assets can be productive. And I'm a little sad to say that I think that's coming to an end. We can still go make about 3.5% in short-term treasuries. I honestly don't think that the Federal Reserve is going to have a good reason to lower interest rates, perhaps for the remainder of 2026. They didn't in the last meeting, and the futures market says if they do again, it probably won't be till halfway through the year. I'll give you some evidence later on that they might not lower it at all this year. Could even have a need to raise it a little bit, but at least as it stands right now, we're still beating inflation, but inflation goes up a little bit. That won't be the case anymore. The margin is definitely narrowed. If you're owning treasuries in a taxable account and you're in a high tax bracket, so you're paying taxes on the ordinary income that comes off of those, at least at the federal level. Treasury income is tax exempt at the state level. You're just barely staying ahead, but we're looking at a number of different municipal bond solutions. And if you start to grow concerned about the size of our national debt and the ability for the Treasury to pay back those long-term Treasury bonds, you might be more interested in these muni bond strategies. And I'm even suggesting that perhaps munis are the new treasuries in terms of safety, because a lot of states have balanced budget requirements. And you might decide that munis are, in fact, in many cases, safer than treasuries in the long run. So a lot to talk about there. So yeah, again, been a great 3 or 4 years when the safest possible assets were yielding so much higher than the rate of inflation, but that is coming to an end. As we look at the yield curve to illustrate the point I just made, you'll notice in the top middle portion of this slide, that's where I'd like to focus your attention. What we call the short end of the yield curve is showing that yields are less than they were a year ago. But also notice a separate point, and that's that long-term interest rates in the United States have not risen. So it moves on a minute-by-minute basis, but right now the federal government can issue 30-year Treasury bonds at a yield of about 4.9%. And I know when I'm talking to live audiences and I ask people to volunteer what kind of yield they would require to give their money to the federal government for 30 years, the most common response is somewhere closer to 10%, so about double what the Treasury is actually having to pay. Now, I'm going to show you some information here in a bit that suggests that something higher than 4.9% might be the real market rate, that long-term rates are being artificially suppressed for better or for worse, but that would be a good reason for us to not suggest that client money go out there and lock up a 4.9% yield for the next 30 years. So when we go back over what we were talking about in 2025, I'm going to give us a checkbox, a passing grade for 3 of those 4. Again, we kind of got close to a tech crash in the first quarter. We kind of got close to a crypto crash towards the end of the year. But I think crash is probably too strong a word. So we had a downturn, but not a crash. But I think the other 3 key themes were spot on in terms of things we could do for clients and what to watch out for. Beginning our shift now into the future, we're going to talk about some things that happened most recently and at the same time set the stage for the next section. So let's first talk about country returns. And the headline is Get Out the Globe. We're going to show you with these country returns something that I think could very well repeat itself into 2026 and perhaps even beyond. So when we look at all the countries that we could possibly invest in, what we see is that there's some pretty enormous returns for 2025, approaching 100% for Colombia, although Korea and Spain and Hungary did pretty well also. If you look all the way towards the right side, you may notice a green bar, and that's the United States. So again, nowhere near the highest return. Look a little bit to the left of the United States and you'll see a blue bar in the bar chart, and that is the global average. Now, you might be thinking, why isn't the average somewhere closer to the middle? And that's because these are dollar-weighted returns. And so the United States is about 2/3 of the value of the total global stock market. So the global average gets pulled close to whatever the U.S. did, up or down. But this was clearly a year where outside the U.S., were more productive markets, even though the global average in the U.S. appear to be pretty close to each other. When we chart out all the headlines that would have affected the return that you see depicted here, which is that global equity index for all of 2025, you may notice there's a few more headlines than normal. Often I have about 8 or 9 or 10 that are worth looking at and even dissecting a bit. But there were so many headlines in 2025, it seemed like almost too much news to keep up with. If you were watching the news, you might have been stressed out about all that. I did hear somebody say that 2025 felt a bit like having surgery without anesthesia. But if you just looked at the value of your accounts, you might have blinked and missed the fact that we had a bit of a downturn around some tariff news in the first part of the year, but then things came right back. And this is the 3rd year in a row that we've had a pretty terrific stock market. And so one thing I've heard over and over from our clients is that their own balance sheets are about as big as they've ever been. Individual circumstances can vary. But if you're looking at your own balance sheet, the value of your houses and cars and the investment accounts and everything, there's a good chance that they're the highest value that you've ever seen them. Certainly if you're not in retirement and drawing down heavily. So most folks are pretty happy. If you missed the news and just saw the value of your investments, it was certainly a terrific year. Now, when we put some hard numbers to that and we vary that across risk ranges, just take a look at the 1-year column there. So the U.S. fixed income index was up about 7, probably a little higher than most of our clients got. There's a lot of volatility in that fixed income index. If anybody got the +7 in their public market fixed income investing, they probably also got the -13 back in 2022. So our clients have had a much more stable, much more productive ride by us taking some of the risk out of how we invest in fixed income. But take a look at the lower end of the rows there and the global equity benchmark with a 1-year number over 22% and a 3-year number almost at that level. That's a pretty amazing thing to see. And so if if you could get that going forward, and that's certainly not something that we're expecting, at 20% a year, you're going to double the size of that equity portfolio about every 3.5 years. That's pretty amazing to see. The long-term numbers are a bit lower, but I'll comment that going forward, if inflation does manage to stay between 2 and 3%, an equity return in the public markets of 8 to 9% is much more likely to be what we're going to get in the future. Now, looking back even farther, in this case, we're going back to 15 and 20 years, we can see some interesting data. And this is really my opportunity to call out how different this last year was. So for the moment, just focus on the 1 year numbers. You'll see the U.S. stock market, and there's some different indexes used in this presentation to try to measure that. We see it being up over 17%. But look at international developed market stocks, up almost 32, emerging market stocks up over 33, so almost double what we saw within the US. That's how big a difference that was. Global real estate didn't do great, mostly because of problems within the US. So I'm really looking at that 1 year and thinking how many folks were kind of frustrated at the returns that we were getting out of the overseas markets. But even including that last year, take a look at the 5 year numbers. You can see the dominance of the U.S. We do overweight the U.S. That's been a great long-term strategy. But for 5 years and 10 years and 15 and 20, the U.S. has almost always been a better deal. But what's been going on in the last year is our currency has been weakening. And the currency can weaken for a lot of reasons. Holding long-term rates down can be one of those reasons. I'll get into that in a bit. But this weakening US dollar has a number of effects. Well, the first is if the dollar was weakening, those foreign currencies were strengthening. And so when we invest in overseas equity markets, we're really investing in a foreign currency and a foreign stock market. So when the foreign currency strengthens and the foreign stock market goes up, you get the compounded effect of those two phenomena. So that's how we get these really terrific numbers coming out of that. So again, this weakening currency is a benefit to us in that way as investors, but it can hurt us in the sense of what it can do to future inflation. When our dollars are weaker, and I bet most of us get paid in dollars or certainly are invested in dollars, when we need those dollars to buy something, if it comes from overseas, we tend to have to use more of them, right? And so that is the definition of inflation. We're using more dollars than in the past to buy the same goods or services. So a weakening dollar can be good for U.S. manufacturers. Their goods are cheaper overseas, but for us, overseas goods are more expensive. And again, we can compensate for a lot of that by making sure that if we get this inflation that comes with a weaker currency, we're also being the beneficiary of having some of our equity investments be outside the U.S., outside the U.S. dollar. Now, I've shown you some pretty good numbers for 2025. I do like to recall what the other experts were saying a year ago. And while we did not come up with a specific prediction, here's what happened with the S&P 500. That's not the total U.S. stock market. And in this case, it's the price return. So this is excluding dividends. But the actual number was terrific, over 16%. Only those super optimists over there at Wells Fargo predicted that it would end up higher than that. You see a lot of other firms that did predict a positive return. Those are all in green, but you'll see a Citigroup at 7.35 and a Goldman Sachs at 3.94 and so on and so forth. Some of these firms even changed their prediction mid-year. So we've got a few edits into that. But then there were some firms that were predicting that it would be negative. And after coming off of two really just incredible up years, that's not an unreasonable thing to predict. But perhaps the biggest takeaway for all of us on the call today is to see that nobody got it perfectly right. And in fact, most firms got it pretty darn wrong, right? So if you're hearing predictions for 2025, for 2026, if you're hearing predictions for 2026, be very careful about that because there's very little chance that any of them are going to be very accurate. Okay, let's go through the markets in a little bit more detail, but we'll be quick about it. If you look at the top part of this page, what you'll see is that value stocks were really doing far better than growth stocks as we got towards the end of the year. That really helped to to take back some of the gains that growth stocks had put on value. And as we sit here today, value has definitely been the best place to be so far in 2026. We know over much longer periods of time, the evidence suggests that value stocks tend to be the best place to be. But again, what's been going on in 2026 so far has been so severely in favor of the value stocks and again against the growth stocks that if we were to run 3, 5, and 10-year numbers right now, they'd look pretty different from what you see on this page. Overseas value stocks also did pretty well. Now, outside of the US, our value tilt has worked very reliably. The large, super large tech stock phenomenon is really only a US phenomenon, so that overweight to value has been a pretty good strategy on our part, and we enjoyed that again in the fourth quarter of 2025. Same story with emerging market stocks, but perhaps even a little bit more extreme in terms of the returns if you just indexed it. But again, value stocks did particularly well, so we were pretty happy with that. Turning to REITs, not great news within the US, but better news outside the US. When you look at the full year, you'll see that everything made money, but there's a lot of stresses within the US, and it is worth noting that we're all reading a lot about the explosive growth of the big data centers within the US because of AI, because of cloud computing. And it can be hard to get investment dollars into those things. A lot of times they're owned by Alphabet, they're owned by Meta, they're owned by these other firms where you would have to invest in that stock to get that piece of real estate. So stresses in other areas, warehousing tended to do okay. Multifamily housing, not so much. Rents are down. And what I'll say for folks here on the call is, home price movements have shifted. The best returns in the past year have tended to come from the Northeast, not the Southeast, where we had seen those in the past, with the exception being Florida. And if you've got any condo exposure in Florida, you may already be aware that that's been a really tough market and maybe going to get even worse. So just not a great year for real estate in the U.S. in any particular way, but a much better year overseas. Now, let's really get into the future, and I'm going to pick up on some of those themes we just talked about. The first one is global interest rates. And when we look at these charts here of interest rates by all the major sovereign debt issuers, you may notice at the top, not a big change in long-term interest rates for the US and the UK. But in other economies around the world, long-term rates began moving up. And we need to ask ourselves if long-term sovereign debt is really all that safe, because so many economies are running major budget deficits and the amount of national debt is only growing. Well, that's certainly the case in the US. I'll tell you in a minute why our interest rates did not move up. But let's take a moment and focus on Japan. So I've got a slide here that shows you what's happened in Japan over just the last few years for their 30-year bonds, their 20, their 15, their 10. Notice that in 2022, those interest rates were well below 1. And in some of the years prior to what's on the slide here, we actually had some negative interest rates. We had this crazy phenomenon going on in Japan where with negative interest rates, that meant that if you put your money in the bank, you might get back less. And so home safes became really popular in Japan. You could at least take out the same amount of money that you put in a negative interest rate environment. But suddenly interest rates have skyrocketed. And what's been going on, what's changed, why this is so important in Japan is that for decades, we've had no inflation in Japan, even deflation in Japan, and ultra low interest rates. And if you could only invest at less than 1% in Japan, that also meant that big financial players could borrow for less than 1% in Japan. And so this enormous trade reaching into the trillions, if you look across the decades, had emerged, called the Japanese carry trade. So let's just say, for the sake of argument, you borrowed in Japanese yen at 0.75%, invested in U.S. Treasuries at 4%. You got a pretty nice margin there. And this was an absolutely enormous trade and created a lot of a demand for U.S. Treasuries. But But frankly, that trade is more or less evaporated because the borrowing costs are so much higher now in Japan. You just don't have that margin to borrow cheap and invest at higher, relatively higher rates in the U.S. like you did. So it's pretty much evaporated, and that's a real problem for Japan. So it's actually causing the interest rates to move even more to the point where the U.S. could intervene. And there have been some brief periods of intervention in the past by the U.S. to help Japan that usually resulted in our own currency weakening. And that would, if that happened again, that would be on top of an already severely weakened dollar. So there's a lot at stake here. I'm not quite sure I'm going to call it a crisis yet, but it seems like it's headed towards a crisis. So definitely be paying attention to Japan in your own newsfeed. A somewhat different type of analysis here, but I'm going to tie all this together in just a few minutes, is this chart of consumer confidence. And we've got two different lines graphed here. There's the present situation index, which seems much better than the expectations index, although both are moving downwards. So the expectations index is obviously the future. The present situation is what's going on right now. It does remind me that I'll often talk to a client and ask them how are they doing, and they may talk about their pessimism about the economy, pessimism about politics, whatever's on their mind. But when we get down to how they're doing personally, they're often doing great. And so, at least at the moment, a lot of people's present situation is better than what they're expecting in the future. But there's something else to understand about these tables and charts that come out, and that's that the consumer confidence measures span across the entirety of the U.S. population. And so, someone with a lot of money gets weighted the same in these surveys as someone with fewer economic resources. So it's meant to reflect everybody. Now, we know that consumer spending is a big part of the U.S. economy. We are a consumer economy, right? But let me show you another slide and a little secret here that does not get talked about very much. And that's the fact that, let's say, if you're on this webinar, you're probably in the top 20% of earners. The top 20% of earners are responsible for about half of all consumer spending. So perhaps a more useful survey would be one that says, what do the top 20% of earners think about their current situation and think about the future? Some of the surveys of that nature that I've seen would say that the top 20% feel a lot better about the future than the bottom 80% or certainly the bottom half. Now, the bottom half of Americans in terms of net worth don't even own a share of stock. But here's what's happened. This is actually way more profound than you might think. When I went to business school, I was taught this fundamental concept about the stock market. The stock market reflects the state of our economy and where the economy is going. But I think that may have flipped. If you're in the top 20%, as we said before, your balance sheet is probably as big as it's ever been. So you can spend if you want to spend. And so the economy is beginning to reflect the value of the stock market. So that's flipped. If the stock market's doing well for whatever reason, you feel fine about your consumer spending. And if you want to spend some money on a car, a house, whatever the case may be for you, you're much more likely to be able to do it. And so we've got pessimism in general. We've got outlooks in general coming down. But I'll suggest to you that may not be the case if you're one of the folks that's on this call, and with good reason. We're going to talk a little bit about the money printing machine that the Federal Reserve owns. If we increase the money supply dramatically, financial assets, stocks and bonds tend to inflate in price. Certainly the stock market inflates relatively quickly when money gets printed. And so if we have a problem with interest rates, if the Fed has to come to the rescue printing money, then if you've got an investment portfolio, if you're in the top half of Americans that has some stock market exposure, you're probably going to be fine. We've certainly got the tools to try to help make sure that you're fine. It's if you're in the bottom part that you're not so fine. So this all really does make sense that the bottom part would not be so excited about the future. Now, often I'll try to predict future inflation by looking at what's been going on with with commodities, because if commodities get more expensive, that makes its way through the supply chain, and then other things get more expensive. But there's a peculiar bit of data depicted here for 2025. The biggest increases in price were not in industrial commodities. They weren't in cotton. They weren't in coffee. They weren't in heating oil. They were in silver and gold. And I'll just let you know that there are two competing theories out there. If you like to investigate this kind of stuff, you might know this already. Well, the first is a bit of what we talked about already. Sovereign debt quantities are escalating. Major economies are living on their borrowing capacity, and so there's some doubts about the value of sovereign debt, and so maybe there's a need for an alternative currency of sorts. And the silver and gold trade has been around for thousands of years, and so you have this run on silver and this run on gold. So that's kind of one theory, and not one that we're not unfamiliar with. The competing theory to that is that physical stocks of silver, physical stocks of gold are not what we've been told. So major investors in precious metals are investing through what are called futures contracts. And there's an expiration date to a futures contract, and often that is just settled financially. You and I can go into a brokerage account and trade some futures these days. They're just settled financially. But the bigger players have the option to settle that with what's called physical delivery. And so you can buy a silver contract if you're a big enough player in the financial system and demand delivery of the silver bars at the end of it, or demand delivery of the gold bars at the end of your gold futures contract. There's some funny stories out there that might be a little bit made up about traders ending up with a tanker full of oil, or shipments of lean hog bellies, or live cattle, or tons of coffee, things like that. That probably some of those instances are exaggerated, but still fun to talk about. But you can very definitely do that kind of thing with silver and gold. And so that's been a real trend, to the point that some countries are prohibiting the export of these precious metals from their vaults. So, there's a rumor that Fort Knox might not own what we've been told it owns, and the audit has not happened for decades. And so the internet will keep you entertained with all of these theories out there. So a lot of physical delivery being demanded, not all of it being fulfilled, and that has caused the value of silver and gold to skyrocket. It has come down a lot since the end of 2025, but quite volatile on a day-to-day basis. Some days down hard, some days back up quite a bit. Now let's go look at another commodity here, and sometimes people are just looking for something really useful to come out of these webinars with, a bit of information that they could do something with, and perhaps this is one of those. This is the price per therm of natural gas in the U.S. These are average prices, of course, and this is the spot market. This is not for futures, so this is the spot price for natural gas, and what you'll notice is that it ran up just recently. So if you two were covered up in some of the winter storms, you know why that was. It got really cold in parts of the U.S., and the demand on natural gas went way up. But there's something else going on in the natural gas market that you should be aware of, and that's that those nice low prices for oil are causing a real problem with natural gas, and it could get much worse. So, maybe the nugget for you to take away from this is, if you've got natural gas coming into your home, you might want to lock up that longer term contract to protect yourself from this kind of volatility in the future, because when oil is as cheap as it is right now, oil well drilling stops. And that's a bigger deal than you might think. Um, uh, First of all, 35% of all natural gas is what we call associated gas. It comes from oil wells, right? So if we stop drilling oil wells, we're not going to get as much natural gas in the future. And across much of the U.S., certainly the Permian Basin, which is a big part of oil and natural gas production, goes through Texas and beyond. 1 year after a new well has been drilled, production of oil and gas drops by 50%, and about that much the following year. So you're drilling wells constantly if you want to keep up with demand. And oil drilling has more or less come to a screeching halt because of the low price of oil. So one of the things we can expect in the future, if something doesn't change, is that production of oil and natural gas is going to plummet. and that might send the price up, but maybe not right away. And it takes a while to catch up on that oil well drilling phenomenon. So we also now are contractually obligated to ship a whole bunch of liquid natural gas out of LNG terminals. And so that's also going to shrink the supply. So a lot going on in this market. And you might see your gas prices go up a little, but you might see, and that's gasoline prices, but you might see your natural gas prices skyrocket. So you can take a look at the bill for the month that we're getting through right now with these storms and get a sense of where that could possibly go. All right, let's move towards the end of the presentation here. I've got a slide showing you what we think is going to happen with the size of our national debt as a function of our gross domestic product. But there's some scenarios where that could really run away with us. And I'm showing you a pie chart here so that I can explain why that could be far worse. There's a group called the Committee for a Responsible Federal Budget that does a lot of this type of analysis, and they're starting to model out these disaster scenarios that we have talked about in these webinars in the past. So these disaster scenarios that the Committee for a Responsible Federal Budget is modeling acknowledge this. So when you look at this pie chart and you realize who actually owns U.S. Treasuries, it's probably not who you think. We read a lot of news about the foreign countries that are owning our treasuries, and you can kind of see that at the top, the UK, China, Japan, and other countries all aggregated together. You might be surprised at how small those pie wedges are. You've got a very big wedge for the U.S. non-bank public. Well, that's me and you, right? We might have some treasury exposure in our portfolio. Then you can look at U.S. commercial banks. Well, if you're in the banking business, you've probably got some exposure to treasuries as a part of your own balance sheet. You'll see an even bigger wedge with intragovernmental holdings. Well, the Social Security Administration has been investing its trust fund in treasuries for as long as it's had excess collections, which, by the way, are shrinking, but there's still excess collections, and that trust fund is invested in treasuries, as are other aspects of the entitlement programs for the U.S. And then there's this big yellow wedge there, and that's the Federal Reserve. And what the heck is the Federal Reserve doing owning U.S. Treasuries? We already see that intragovernmental holdings are pretty big. And so between that and the Federal Reserve, the government owns more than a third of its own treasuries, which seems kind of odd, right? Well, the Federal Reserve has some special powers that the rest of us only wish we could have. They can walk over to a terminal and create cash whenever they have the need to do so. They literally do that electronically and then go spend that cash, often to buy treasuries. And that's a way of injecting cash into government coffers, which is then promptly spent. And that excess governmental spending, well beyond what they take in taxes, then floods the economy with cash, increases the money supply. It buys fighter jets and bullets and builds bridges and roads and does all these other things that the government does with that money. So that's a way of putting a lot of money out into the economy at a pace that rapidly exceeds the growth of the economy. And so when you got money supply going up faster than the growth of the economy, you get inflation. So one thing the Federal Reserve can do, and in fact is chartered to do, the Federal Reserve has three missions. One of those is to keep down long-term interest rates. We hear that the Federal Reserve is supposed to keep us at full employment, and I really don't know how they're supposed to do that effectively, but it's part of their mission from Congress. They're supposed to keep inflation down, which is why they did not lower rates at the last meeting. They're very worried about inflation, but they're also supposed to manage stable long-term interest rates. And so when our Treasury needs to issue more 30-year bonds, the Federal Reserve will buy those regardless of the interest rate that is offered. So if you and I demand 10% to buy 30-year bonds, the Federal Reserve is willing to buy them at 4.9%. In a couple of meetings ago, the Federal Reserve seemed to indicate a nice willingness to do this. They call it quantitative easing. However, this is the recent development in this whole kind of complicated debt situation. The White House's new nominee for the Federal Reserve chairmanship, Kevin Warsh, uh, doesn't like that mandate from Congress. And frankly, I don't either. I think it's kind of too much for a central bank to be doing, but that's kind of where we're at. And he wants to shrink the Fed's balance sheet. Well, what happens if the Treasury has to offer 10% yield to get 30-year bonds out the door? If the Federal Reserve is not willing to buy them, then that's the going rate. And that's how you get into this kind of spiraling debt relative to the size of our economy. So for many people, Kevin Warsh could be a little bit of a disaster for this situation. Other folks like him, but we're going to have to keep an eye on what happens with 30-year Treasury rates. He could end up slipping into quantitative easing by necessity to keep interest rates down. He's supposed to do that. That's part of the charter of the Fed that comes from Congress. But in doing so would incite some inflation, which might mean that the Fed has to raise short-term rates to battle the inflation. So anybody running the Fed might be stuck between a rock and a hard place in the very near future. Okay, if you want to go to the Committee for a Responsible Federal Budget and read a little bit more into this, here's a list of all the headlines that you might want to pay attention to suggest that the crisis has begun. Might not be a crisis yet, but going down that slippery slope is something we all worry about if we follow that type of stuff. And here's an example of some of the headlines that could send us down that road. So let's wrap up with a little bit of math. One of the things that you'll see here is, again, those first quarter returns in 25, the full year returns in 25 for those top 10 stocks. And then what happened to the price earnings ratio. And for the PE ratio, the dollar you pay for a dollar of earnings went up for some stocks, down for others. For the top 10 stocks, it's about what it was, 33 versus 34. That stayed about the same, down a little. The price you pay for a dollar of earnings for the whole of the S&P 500 is about the same. P ratio of 22 a year ago, 22 now. So again, that's the whole S&P 500. But what about those other 490 stocks that are not in the top 10? Well, the price earnings ratio for those, again, that's the dollar we pay as investors for a dollar of earnings. It was 16 a year ago. It's about 16 now. And guess what? 16's kind of been the magic number over history. So if we could snap our fingers right now and have the entire US stock market valued where a 16 PE was what every stock was priced at, what would happen to those top 10 stocks? Well, that's what we're depicting here. Not suggesting that's going to happen, but again, the P of 16 is kind of the sweet spot. If you look at decades and decades of historical data, we see how far those top 10 stocks would have to fall if the right PE ratio for them was only 16. So we've got this big AI trade sending a lot of these significantly higher. The expectation is that earnings will be higher. Most of them had pretty good earnings in 2025 and were able to sustain those rallies, but there are reasons to think that earnings out of AI could crack. One thing we talked about during the year was what's going on with NVIDIA. So NVIDIA sold a lot of chips. They made a lot of money. Nobody can really doubt that phenomenon. But then they took that cash that was on their balance sheet, took it off their balance sheet, bought interest in a lot of other AI firms out there. So their balance sheet stayed the same. They swapped cash for investments, equity investments in other firms. Those other firms then turned around and used some of that money to buy more NVIDIA chips. So if you think about it that way, NVIDIA took the cash that was on their balance sheet and moved it to their income statement. So it showed their income going up. So that trade has been questioned quite a bit. We won't spend any more time on it today, but that could be a reason that the earnings might actually change for NVIDIA. But there's reasons to question the earnings for a lot of these others if they don't grow at these exorbitant rates, in some cases about twice as much as these numbers would suggest would happen for the rest of the market, the S&P 490, that if they don't do that, then you could see some significant price declines. That's actually been happening in 2026. Then we'll turn around and have an update that'll rescue those stocks a little bit. So very volatile times right now in the market. All right, let's just jump into 2026 and be done. We already did the first key theme, revaluing of debt and currency. So you know an awful lot about that. We're looking at shifting global trade power. That your news feed might be filled up with new trade agreements happening all around the globe that leave out the U.S. That's something we're going to watch and talk about. Using math to your advantage. We love to do math here at BIP Wealth, and we're going to save some of these nuggets for later in the year. Sometimes there's a little piece of math that could increase your return or lower your risk in your portfolio or other financial situation. We'll talk about that. And then lastly, we are already in the era where there's a lot of maneuvering for what's to come when Trump is no longer in a position of power. A lot of this is happening already within the Republican Party. Of course, you can guess that that's been happening within the Democratic Party all this time. So there's a lot of rumors out there online about health and other things, and we're not going to go down that road. But just within both parties, a lot of maneuvering. And as we get throughout 2026, the midterm elections are going to be a very big deal that we'll talk about. We have an idea of what would happen if those elections were held today. That data can change significantly in the coming months, but it could have significant effects on tax rates, significant effects on monetary and fiscal policy, all sorts of things. So that's going to be a big deal to talk about, again, as the midterm elections get closer and ultimately we get to see the outcome of those. So just wrapping up, nothing new here. The world is changing. Boy, is it changing fast with AI, with global trade, all sorts of things out there. So that is changing the landscape for investing. We know America is divided. We talk about the political spectrum and how it's divided there. An odd little nugget for you is that there is an identifiable group of voters who are a bit of a toss-up as to whether they would prefer to vote for Donald Trump or Bernie Sanders. And we think of them as being on opposite ends of a linear spectrum, but there's a lot of people out there just looking for some kind of agent of change. So they do share that in common, right? But there's also divided generationally. I don't think we should count on Social Security benefits never being cut if this debt spiral takes place. I've heard it expressed by some young people that, it's baby boomers that screwed all this up, right? You're the ones to blame, so let's cut the entitlements for you and put you in charge of fixing some of this. And of course, we also talked today in the presentation about the economic divide. If you're a top earner, if you've got more assets than most, you might be fine with all these things that are going on. We've certainly worked hard to build the tools for that. If you're in the bottom part of that, it could be a bit tougher. And lastly, as I just said, our key themes for 2026 are there for us to remind you of what we're going to be focused on. We think we have a lot of tools in the toolkit to help you navigate all these changes. And so don't be surprised if you have some new advice being brought to you by your personal wealth advisor, because again, we're working very hard to make sure we can get through this changing world.